On a Thursday afternoon, the S&P 500 did something it had never done before. It crossed the 6,900 line. The financial news networks broke out the confetti. The pundits declared that the AI supercycle was unstoppable. The retail investors, watching their portfolios hit all-time highs on their phone screens, felt a rush of invincibility. But they weren't looking at the volume. They weren't looking at the bond market, and they certainly weren't looking at the exits. 24 hours later, the trap snapped shut. On Friday, the Nasdaq didn't just stumble, it was violently rejected. A 1.6% drop in a single session. The S&P 500, which had just crowned itself king at 6,900, gave back 1% instantly. To the casual observer, this looked like a healthy correction. Just a little profit-taking before the next leg up, right? Wrong. This wasn't a correction. This was a rotation. And in the brutal physics of Wall Street, a rotation is far more dangerous than a crash. A crash is panic. A rotation is execution. While the tech darlings, the Nvidias, the Microsofts, the Apples, were being liquidated by the billions, something else was happening in the shadows. Money wasn't leaving the market. It was moving. It was fleeing the fantasy of future growth and pouring into the fortress of current value. The Dow Jones, filled with boring industrial giants and energy companies, barely moved. The smart money was getting out of the casino and buying the building. This is the story of the Great Rotation. It is the story of how the 6,900 level wasn't a milestone, but a ceiling engineered to trap retail liquidity while the institutions quietly sold the top. We are witnessing the end of the spot growth at any price era and the violent return to the price of reality. 1. The euphoria trap. Painting the tape. At the mathematical impossibility. To understand why Friday's drop was not an accident, we have to look at the Thursday that preceded it. The surge above 6,900 was not driven by fundamentals. It was not driven by a sudden explosion in corporate profits or miraculous drop in interest rates. It was driven by gamma. For months, the market had been locked in a feedback loop. Investors bought call options on major tech stocks, forcing market makers to buy the underlying stock to hedge their exposure. This drove the price up, which led to more option buying, which led to more stock buying. It's a mechanism known as a gamma squeeze. It creates the illusion of relentless demand, but it creates a market that is fundamentally fragile. By the time the S&P 500 crossed 6,900, the valuations of the Magnificent Seven tech stocks had detached from reality. They were priced for perfection in a world that was becoming increasingly imperfect. The PE ratios. Tech stocks were trading at 30, 40, even 50 times earnings. The yield curve. The bond market was screaming a warning, offering 5% risk-free returns while stocks offered a 1% dividend yield. The smart money, the hedge funds, the sovereign wealth funds, the family offices, knew the math didn't work. They knew that paying 50 times earnings for a chip company when money cost 5% was financial suicide. But they also knew that the retail herd was still buying, so they waited. They let the market drift up to that psychological 6,900 number. They let the headlines scream, 7,000 is next. They let the FOMO, fear of missing out, reach its fever pitch. The liquidity event Thursday was the liquidity event. In professional trading, you don't sell when you want to. You sell when there is someone willing to buy. You need a massive wave of buying pressure to absorb your massive sell orders without crashing the price immediately. The surge to 6,900 provided exactly that. As retail investors piled in, convinced that the breakout was real, the institutional algorithms switched from accumulate to distribute. They were selling into the strength. For every retail trader buying a share of a tech giant at the all-time high, a pension fund or a hedge fund was quietly handing them the bag and walking away. This is why the volume patterns on Thursday were so strange. The price was rising, but the internal breadth was weak. Fewer stocks were participating in the rally. The generals, the big tech stocks, were charging up the hill, but the soldiers, the rest of the market, were staying in the trenches. It was a hollow rally, a painted tape, a stage set designed to look like a boom hiding the bust that was already being prepared backstage. The Friday rejection. When the bell rang on Friday morning, the illusion evaporated. The selling wasn't panic-driven, it was structural. The Nasdaq Composite led the way down, falling 1.6%. This wasn't just a bad day, it was a change in character. For years, every dip in tech had been furiously bought up by the buy the dip crowd. But on Friday, the dip kept dipping. The buyers were exhausted, the credit cards were maxed out, the tech slump had begun. The narrative that AI changes everything collided with the reality that price matters. The drop of the S&P 500 by roughly 1% was the confirmation. The breakout above 6,900 had failed. In technical analysis, this is called a look above and fail. It is one of the most bearish signals in finance. It means the market tried to go higher, found no buyers left, and collapsed under its own weight. The trap had been sprung. The retail investors who bought the breakout on Thursday were now underwater on Friday. And the institutions? They were already moving their money to the next battlefield. 2. The mechanism of rotation. Why tech died and value rose. The cost of capital. Why did the rotation happen now? And why did the market suddenly decide on a Friday that Nvidia was expensive but Caterpillar was cheap? The answer lies in the cost of capital. For a decade, tech stocks thrived in a zero interest rate environment. When money is free, future growth is valuable. You can wait 10 years for a company to make a profit because you're not paying any interest on the money you borrowed to buy it. This is why growth stocks outperformed value stocks for so long. But we are no longer in a zero interest rate world. We are in a world of higher for longer. On that Friday, the market finally accepted the reality that the Federal Reserve was not coming to the rescue. Inflation was sticky, the economy was hot, rates were going to stay up. In a high-rate environment, the math flips. Growth stocks, tech, their value is based on profits far in the future. When rates rise, those future profits are worth much less today, discounted cash flow. Value stocks, industrials, energy, banks, their value is based on cash flow today. They pay dividends now. They own real assets, factories, oil wells, pipelines, that go up in value with inflation. The broad rotation mentioned in the financial reports was the sound of capital adjusting to this reality. The flight to safety, that isn't cash. The Dow Jones Industrial Average fell only 0.5%, while the Nasdaq crashed 1.6%. This divergence is the key. Investors weren't going to cash, they were going to value names. They were selling the companies that sell dreams, software, AI, and buying the companies that sell reality. Oil, steel, insurance, food. This is a defensive rotation. It happens when the smart money smells a recession or a stagflationary period coming. Tech is cyclical. If the economy slows down, companies cut their IT budgets. They cancel software subscriptions. They delay upgrading their servers. Tech gets hit hard. Value is defensive. Even in a recession, people need to eat. Consumer staples. They need to heat their homes, energy. They need to drive their cars, oil. They need medical care, healthcare. The rotation was a vote of no confidence in the soft landing narrative. It was the market bracing for impact. The institutions were moving their chips from the high-risk table to the survival table. The AI fatigue. There was also a specific catalyst for the tech slump, AI fatigue. For 2 years, the entire market had been propped up by the artificial intelligence narrative. Every company that mentioned AI on an earnings call saw its stock double. It was a mania reminiscent of the dot-com bubble of 1999. But by the time the S&P hit 6,900, the questions were starting to pile up. Where are the profits? We've spent billions on chips, but where is the revenue? Is ChatGPT actually making money for anyone besides OpenAI? The market realized that the build phase of AI, buying the chips, was priced in, but the monetization phase, making money from the chips, was taking longer than expected. On Friday, the market decided it was tired of waiting. It stopped paying for the promise of AI and started demanding the performance of AI. When that performance didn't materialize fast enough, the rotation began. The capital flowed out of the AI hype trade and into the real-world trade. 3. The anatomy of the value trade. Where the money went hard assets in a soft world. While the Nasdaq was bleeding out, look at what held up. Look at what the value names actually are. They are the infrastructure of civilization. The rotation was a move toward tangible assets. In a world of digital bubbles, debt, and fiat currency debasement, the only safe harbor is things you can touch. Energy, oil and gas companies. Despite the green transition narrative, the world still runs on fossil fuels. These companies are cash machines. They pay massive dividends. They buy back their own stock. And when the Nasdaq falls, ExxonMobil becomes a fortress. Industrials, the companies that build the roads, the bridges, the factories. If the government tries to stimulate the economy, they will do it through infrastructure spending. Caterpillar, Deere, General Electric. These stocks don't need a metaverse to make money. They just need dirt to be moved. Financials. The big banks. Higher interest rates are actually good for them, if managed right. They earn more on their loans. JP Morgan, Bank of America. They are the toll booths of the economy. The rotation was a rejection of the spits and bites economy, and an embrace of the atoms economy, the PE compression. The rotation is also a mathematical necessity called PE compression. Imagine two companies, TechCo trading at 50x earnings. To justify this price, it must grow at 20% every year for a decade. ValueCo trading at 10x earnings. To justify this price, it just needs to keep doing what it's doing. When uncertainty hits the market, wars, elections, inflation, the risk of owning TechCo becomes unbearable. If TechCo misses its earnings by even a penny, the stock crashes 20%, as we saw on Friday. The multiple compresses. Investors are no longer willing to pay 50x, they will only pay 30x. That adjustment destroys wealth instantly. Value Co, however, is already cheap. It has a margin of safety. If it misses earnings, the stock might drop 2%, not 20%. The Friday rotation was the sound of risk premiums being repriced. The market decided that the safety of a 10x PE ratio was worth more than the excitement of a 50x PE ratio. The Dow Jones divergence. The fact that the Dow Jones didn't slipped, only 0.5% while the Nasdaq fell 1.6%, is the smoking gun. The Dow is an archaic index in many ways. It's price-weighted. It has only 30 stocks. It includes fewer tech stocks. But in this moment, its flaw is its feature. The Dow represents the old economy, the economy of production, transportation, and consumption. The Nasdaq represents the new economy, the economy of disruption, innovation, and speculation. When the Dow outperforms the Nasdaq, it means the market is becoming conservative. It means capital preservation is becoming more important than capital appreciation. This divergence is often a leading indicator of a broader trend change. In the late stages of a bull market, the generals, tech, are usually the last to fall. When they finally crack and money rotates into the defensive sectors, Dow, it signals that the cycle is turning over. The party is ending and the guests are putting on their coats. 4. The future of the trap. The 6,900 ceiling. The concrete ceiling. So, what does this Friday mean for the future? It means that 6,900 is now the resistance. In trading psychology, a failed breakout creates a scar on the chart. All the investors who bought above 6,900 are now bag holders. They are sitting on losses. Their only hope is for the market to get back to 6,900 so they can sell and break even. This creates a massive wall of selling pressure overhead. Every time the market tries to rally back to that level, those trapped investors will sell into the rally to get out. The 6,900 level, which was supposed to be the launch pad for 7,000, has turned into a concrete ceiling. The unwinding of the trade. The broader implication is the unwinding of the passive flows. For a decade, passive investing, ETFs like SPY and QQQ, has blindly poured money into the largest tech stocks because they are the largest part of the index. This created a self-fulfilling prophecy. Big tech got bigger because it was big. But if the rotation continues, if money starts actively moving out of tech and into value, the passive mechanism works in reverse. If the Nasdaq falls, the QQQ ETF falls. Investors sell the QQQ ETF. The ETF manager must sell the underlying stocks, Apple, Microsoft, Nvidia, to meet redemptions. This drives the prices down further. This is the liquidity spiral. The same mechanism that drove the market to 6,900 can drive it down just as fast. The tech slump mentioned in the news is not a blip. It is the gears of the machine grinding into reverse. The end of the easy money. Era. Ultimately, this Friday marked a psychological shift. The market realized that the Fed put, the belief that the Federal Reserve will always cut rates to save the stock market, is gone. With inflation lingering and the economy still running hot, the Fed cannot save the Nasdaq. If they cut rates to boost stocks, they reignite inflation. If they keep rates high to fight inflation, they crush tech valuations. The Fed is checkmated, and the market knows it. That is why the rotation is happening. Investors are realizing they are on their own. There is no bailout coming for their 50x PE AI stocks. They have to own companies that can survive without cheap money. The surge to 6,900 was the last gasp of the speculative era. The Friday drop was the first breath of the new era, an era of volatility, of discernment, and of value. The Nasdaq led the way lower, and it may continue to lead. The slump is just the beginning of the repricing. The rotation from tech to value is not a trend. It is a survival strategy. The system wasn't designed to let you escape the trap at the top. It was designed to keep you buying until the very moment the door slammed shut. And on Friday, at 6,900, we heard the latch click.